welcome once again to Intelligent Investment Today. This is the podcast where we explore the timeless principles of value investing through the lens of the father of the craft, Benjamin Graham. And today's episode is perhaps a little bit different. This one is for the more dedicated listeners, the ones who enjoy going beyond the surface, the ones who are not just interested in what value investing is, but in how its ideas were originally constructed, refined and expressed. In other words, this one is for the hardcore Benjamin Graham enthusiasts out there. Because today, we're going to explore a concept from one of Graham's lesser discussed works, storage and stability. Now this is not a book that typically appears on standard reading lists. Indeed, if you want it, you'll have to get Amazon to print it specially for you. And so it's certainly not as widely read as The Intelligent Investor, nor as frequently referenced as Security Analysis. And yet, it offers a fascinating insight into how Graham thought about stability, not just in financial markets, but in the broader economic system. It reflects a period in his thinking where he was concerned not only with individual investments, but with the structure of the economy itself. And importantly, how instability, particularly in prices, could affect both investors and society at large. So today we're going to unpack that idea, what Graham meant by storage, what he meant by stability, and what relevance these concepts might still have for investors today. So, as ever, sit back, tune in, and get ready to take on board another lesson in value investing as inspired by Benjamin Graham. To begin, we need to step back into the economic environment in which storage and stability was written. This was a time marked by significant instability, the aftermath of the Great Depression, which saw sharp fluctuations in commodity prices, and periods of both inflation and deflation. Economic uncertainty was not an abstract concept. In these times, it was a lived reality. And for Graham, this raised an important question. Why are markets so unstable? And more importantly, is there a way to reduce that instability? Now, as investors, we are used to thinking about volatility in terms of stock prices. But Graham was thinking more broadly. He was concerned with the instability of prices in general, particularly the prices of commodities. Because when prices fluctuate dramatically, it creates problems. For producers who cannot predict revenues, for consumers who face uncertain costs, and for the economy as a whole, which becomes more difficult to manage. Graham believed that this kind of instability was not inevitable, that it was, at least in part, a structural issue, and with the right mechanisms, it could be reduced. This is where the idea of storage comes in. At its core, storage is a very simple concept. When there is excess supply of a commodity, you store it. When there is a shortage, you release it. In doing so, you smooth out fluctuations in supply and demand. And as a result, you stabilise prices. Now this might sound straightforward, even obvious, but Graham took this idea much further. He proposed a system in which commodities could effectively serve as backing for a currency, a kind of commodity reserve system. Instead of money being tied to gold alone, it would be linked to a diversified basket of goods, such as wheat, metals, raw materials. These would be stored in times of period of surplus and released during periods of scarcity. The result, in theory, would be a more stable price level and a more stable economy. Now this is not a proposal that was ever fully implemented, but it reveals something important about Graham's thinking. He was deeply concerned with stability, not just in markets, but in value itself. Because from his perspective, instability creates distortion. It leads to mispricing, it encourages speculation, and it makes rational decision-making more difficult. This connects directly to his philosophy as an investor. Because value investing, at its core, is about identifying mispricing, situations where price deviates from intrinsic value. But those deviations are often driven by instability, by swings in sentiment, by fluctuations in economic conditions. And so, in a sense, Graham's work on storage and stability can be seen as an attempt to address the problem at its source, to create an environment in which prices are more stable, and therefore more reflective of underlying value. Now, from a modern perspective, this raises an interesting question. Do we actually want perfectly stable prices? After all, markets rely on price signals. They reflect changes in supply and demand. They allocate resources. And some degree of fluctuation is both natural and necessary. But Graham's concern was not with normal variation. It was with extreme instability. Sharp swings, booms and busts. The kind of movements that are driven not by fundamentals, but by panic or exuberance. And if we think about markets today, this idea still resonates. We see it in sudden spikes in commodity prices, rapid shifts in interest rate expectations, sharp market corrections, periods where prices move far more quickly than underlying value. And in these moments, the concept of stability becomes highly relevant. Because instability creates both risk and opportunity. For the average participant, it increases uncertainty. But for the disciplined investor, it can create mispricing. And this is where Graham's thinking comes full circle. Because while he explored ways to reduce instability at a systemic level, he also developed a framework for navigating it at an individual level. That framework, of course, is value investing. Instead of trying to eliminate volatility, he sought to protect against it. Through a margin of safety, through careful analysis, through discipline. Now returning to the idea of storage, there is an interesting metaphor here for investors. Just as commodities can be stored to stabilise prices, investors can think how they can store value within a portfolio. What assets provide stability? What acts as a reserve? What allows you to navigate periods of volatility without being forced into poor decisions? In Graham's time, this might have been cash, bonds, or deeply undervalued equities. Today, the specific instruments may differ, but the principle remains. A well-constructed portfolio is not just about maximising returns. It's about managing risk. It's about ensuring that you have the flexibility to act when opportunities arise. In other words, it's about creating your own form of stability. Another interesting aspect of storage and stability is Graham's recognition that markets do not always self-correct efficiently. This is an important point. There is a common assumption that markets are rational. The prices reflect all available information. That inefficiencies are quickly eliminated. But Graham's work suggests otherwise. He observed that markets can remain unstable for extended periods, that imbalances can persist, and that without some form of mechanism, whether that's structural or behavioural, stability is not guaranteed. For investors, This has practical implications. It means that mispricings can exist, that opportunities can persist, but also that risks can remain elevated for longer than expected. Which brings us back to the importance of patience. Because if instability is a feature of the markets, then time becomes a critical factor. Prices may not reflect value immediately, but over time, they tend to converge. And this is where the disciplined investor has an advantage. By maintaining a long-term perspective, by focusing on fundamentals, by resisting the urge to react to short-term fluctuations, they are better positioned to benefit from that convergence. Now, it's also worth acknowledging that Graham's ideas in storage and stability were in many ways ambitious. They extended beyond investing into economic policy. They attempted to address systemic issues, and not all of those ideas are practical in today's world. But that does not diminish their value, because they reflect a way of thinking, a willingness to question assumptions, to look beyond immediate problems, and to consider underlying structures. And that, in itself, is something investors can learn from. Because investing is not just about analysing companies. It is about understanding systems, markets, incentives, human behaviour. And the more we understand those systems, the better equipped we are to navigate them. So while you may never implement a commodity storage system, you can apply the underlying principle. You can think about stability, about resilience, about how to position yourself in a way that allows you to withstand volatility, and perhaps even benefit from it. As we begin to draw this discussion to a close, it is worth reflecting on how unusual this particular work is within Graham's broader body of writing. Most investors encounter him through The Intelligent Investor, through discussions of margin of safety, of Mr. Market, of defensive versus enterprising investing. But storage and stability shows a different side, a broader perspective, one that is concerned not just with individual outcomes, but with the functioning of the economic system as a whole. And in doing so, it highlights something important, that value investing is not just a set of techniques. It is a way of thinking, a way of approaching uncertainty, of seeking rationality in environments that are often anything but rational. And perhaps most importantly, a way of maintaining discipline in the face of instability. Because whether we're talking about commodity markets in the early 20th century or global financial markets today, the underlying challenge remains the same. Prices move, sometimes rationally, sometimes not. And as investors, in environments that are often anything but rational, we must decide how to respond. Do we react? Do we follow the crowd? Or do we step back, assess value, and act with patience and discipline? That ultimately is the enduring lesson, not just from storage and stability, but from the work of Benjamin Graham as a whole. And on that, we draw to a close this edition of Intelligent Investment Today. I do hope you've enjoyed this slightly deeper dive into one of the lesser known ideas from Benjamin Graham, and how it connects to the broader principles of value investing. Do subscribe or add to playlist, so that you'll be notified as soon as any new edition lands. I'm David Coombs. This has been Intelligent Investment Today, Until next time, stay safe and happy investing.